You've probably seen the posts floating around social media, the ones claiming there is a massive shadow government pulling the strings of the global economy. The rumor usually goes like this: a single secretive company secretly owns Apple, Amazon, Microsoft, Pfizer, and basically every other major brand on Earth. But that rumor is false. BlackRock does not actually own those companies. The truth of what they are doing is far more dangerous. Instead of cinematic villainy, their actual strategy is highly technical, incredibly dry, and completely invisible to the average person checking their bank account. This technical fog makes the company nearly impossible to regulate or resist. It is difficult to mount a defense against a system that feels too boring to even notice. To understand how they got this power, we have to go back to 1986. A young trader named Larry Fink was making a massive name for himself in the Wall Street bond markets. Then he made a catastrophic mistake. He bet the wrong way on interest rates, and in a single afternoon, $100 million was completely wiped out. Fink realized why he failed. He, along with the rest of Wall Street, was running blind. Traders were making massive bets based on gut feelings and past experience, rather than using real-time mathematical data to measure their actual risk. 2 years later, Fink gathered a team and founded BlackRock. The entire purpose of this new company was to build a software system that could instantly and mathematically calculate financial risk before a crash happened. A humiliating personal failure became the exact blueprint for a data infrastructure that would eventually monitor and map the entire global economy. That software they built is called Aladdin. Today, it analyzes $21 trillion in assets. That is roughly 10. It doesn't legally force any of its clients to buy or sell a single stock. However, more than 200 of the world's largest financial institutions use it to measure their risk. If all the biggest players ask the exact same algorithm for advice, they begin to move in exact unison. If Aladdin looks at the data and flags a specific government bond as risky, hundreds of pension funds and banks might decide to sell it at the exact same moment. The sheer volume of those synchronized sales causes an artificial crash. When one piece of software acts as the universal advisor, its mere recommendation possesses the power to dictate global market movements. In 2009, BlackRock acquired a platform called iShares. This gave millions of ordinary retail investors a cheap, accessible way to put their savings into exchange-traded funds, or ETFs. But there is a hidden catch in the ETF structure. When you buy into one, you own the economic value of the shares, but BlackRock quietly retains the corporate voting rights attached to them. BlackRock pools all those borrowed votes together to dictate boardrooms. In 2021, they used this massive voting block to support a tiny activist hedge fund and force a change in the board of directors at ExxonMobil. They cast these massive, company-altering votes at thousands of corporate meetings every year, and they do it without ever asking the retail investors for their permission. By separating economic ownership from control, BlackRock aggregates the capital of millions of people to install its own directors and dictate policies to the world's largest corporations. This creates common ownership, where one entity is the top shareholder in competing companies. Take airlines. BlackRock is the top shareholder in Delta, United, and American simultaneously. Because they profit if all three make money, there's zero incentive for aggressive price wars. Researchers have measured the result of this. Without fierce competition, airline ticket costs are artificially inflated by 3 to 7%, passing the financial burden directly to the consumer. BlackRock does not need to build a literal, illegal monopoly to extract wealth from the public. They simply use their omnipresence to quietly kill market competition from the inside. Because of this immense market power, a revolving door has formed between BlackRock executives and top government positions. During a systemic crisis, state reliance on BlackRock becomes inevitable. When the global economy halted in March 2020, markets collapsed. The United States Central Bank needed to execute a massive intervention to stabilize the system. The Fed hired BlackRock to buy up corporate assets on their behalf. BlackRock then turned around and used that government money to purchase its own ETF products, acting as both the player and the referee. When the government outsources its core crisis management to a private firm, that corporation integrates into the state's own power structure. For years, BlackRock aggressively pushed environmental and social corporate policies. They supported these proposals nearly 47% of the time when it was highly profitable and attracted investors. Then the political winds shifted. States like Texas threatened to withdraw billions of dollars in state pension funds if BlackRock continued forcing this agenda on oil and gas companies. Faced with losing actual capital, BlackRock immediately capitulated. Their voting support for ESG proposals plummeted from 47% down to just 4.1%. They proved they have no actual ideology, only a pragmatic drive for capital. Their strategy targets physical permanence, acquiring airports and power plants to shift their influence from digital ledgers to the actual ground beneath our feet. BlackRock functions as the essential operating system of global finance, a framework so deeply embedded that unplugging it would crash the entire grid.